In this video, we will continue talking about interest rate risk within the financial institutions universe. Most countries, the financial institutions that report using the book value of accounting. By now, you should be aware that book value and market value typically are two different numbers. It doesn't have to be, but typically either the market is below or above the book value for different reasons. So in order to reflect the current market conditions, whoever is reviewing the books should also be aware that they need to do some kind of market value accounting or marking to market to understand the differences between them in that specific institution. And it also depends what kind of work you do and what are you analyzing. So let's talk a little bit about price sensitivity and maturity when it comes to liabilities such as debt, bonds, to be more specific. In this context, we will see how we can then expand price sensitivity to change sensitivities to other areas. So in general, the longer the term to maturity, the greater the sensitivity to interest rate changes. Okay, so let's start from the maturity premium, that when you have, let's say, a bond of 2 years versus a bond of 30 years, there's more interest rate risk in one of them. There's also reinvestment risk in the other one. The point is that when it comes to interest rate risk, the one with a longer maturity has more risk because there's more opportunity for changes to happen in the market. The longer maturity bond has the greater drop in price because the payment is discounted at a greater number of times. So the logic is, as I said, the interest rate on a bond is pretty much fixed, the coupon rate. So the longer the maturity, the more chances are of changes of interest rate throughout time. Now, the mathematical issue is that when you do the calculation, you doing a discount for a longer period of time is more future. The future is further away, so it gets discounted at a higher rate. Well, not a higher rate, but more times. Duration. Duration is a term that we use for calculation that we do to check the sensitivity of the price of a bond, for example, to interest rate changes. So what we are eventually calculating is, if I have a bond with this coupon rate and this maturity, if there's a change in the interest rates in the market, how would the price of the bond change? Now, remember, if interest rates go up, bond prices go down. But the question is, if interest rates go up by this much, how much will the price go down? And that's the general idea. So by definition, weighted average time to maturity using the relative present value of the cash flows as weights. We will see the formula in a moment. More complete measure of interest rate sensitivity than is maturity. The units of duration are years. To measure and hedge interest rate risk, financial institutions should manage duration gap rather than maturity gap. So what are we saying there? Let's do a recap. Duration is a calculation you do, and it gives you a factor. That factor is then used in a different formula in order to calculate the price change that would happen with a interest rate change. Now, going back to what we learned in a previous chapter, you want to do some kind of matching, the time buckets, some kind of matching between the maturity of your liabilities and the maturity of your assets. You don't want to have a 2-year asset somewhat paired or matched with a 20-year liability, because then you start creating that gap that we spoke in a previous chapter. So you try to minimize that gap between assets and liabilities and the maturities. However, it's not perfect. So that's one way to start reducing risk. But that is a simple practice used by smaller institutions. As you get more complex and it's more difficult to maintain those maturity gaps small or eliminate them, you may want to then manage what we call the duration gap. Once we understand a little more about duration, you'll see. So some assets may not have the same maturity, but have the same duration. So when the price changes, they will change about the same. And then that way your assets and liabilities change about the same rate, instead of just maturity where they may have different durations. Real quick to get this out of the way, zero coupon bonds, because they don't have an actual coupon rate, is always sold at a discount. The duration and the maturity are the same. So for duration to not be the same as maturity, the measurement, there must be some kind of interest rate involved, some kind of coupon rate involved with the bond. And duration should always be less than maturity because the interest rate sensitivity they have. So we also have this thing called console bonds. A console bond pays a fixed coupon each year indefinitely. Think of this as a perpetuity, similar to stocks, preferred stocks that pay dividends in perpetuity. Or there's a constant dividend in common stocks. Those are perpetuities, can be seen as perpetuities as well. Now, notice I said constant dividend, not constant growth dividend, which is different. Then the formula becomes a little simpler. So to get this out of the way, if you have a console bond, which is a bond that doesn't expire, in other words, doesn't have a maturity date, then the calculation is done this way. Since maturity, it's infinity, then the duration is just calculated 1 plus 1 over whatever the rate is that you're using, and that's your duration. Now, features of duration. So we continue explaining this. Duration and maturity. Duration increases with maturity of a fixed income asset, but at a decreasing rate. So it starts steep, the curve going up, but then it starts flattening it out. Duration and yield. Duration decreases as yield increases. Duration and coupon interest rates. Duration decreases as coupon increases. So these are relationships between duration and maturity, duration and yield, and duration and the coupon interest, the coupon rate. So those are, if one goes up, one goes down. If one goes up, the one goes up, etc. Now, what is duration measuring? So we use it to measure the price change. So how the price changes according to the changes in interest rate. And at what rate does it change? So that's a form of elasticity. And that's what we mean as a direct measure of interest elasticity or sensitivity of an asset or liability. So a couple ways to understand how duration works. Okay, so first you'll have to calculate duration. For that one, we have a video with an Excel sheet example, how to calculate duration and modify duration for that matter. And you can watch that in order to follow that. Once you have calculated duration, that's where this negative D comes in place. So the calculation gives you D for duration, but then what we're saying is that since this is equivalent to the negative of that duration, you can move the formula around because what you're looking for is the change in price. So the change in price divided by the price itself will give you this formula. You can find it through this formula. Now, remember again, once you calculate duration in a different calculation, you bring it in here. You have to put that negative in front of it, and then you use the interest rates in the brackets, and that gives you that. The modified duration, which is also discussed in the other video on the Excel sheet, similar approach. You put a negative in front of it, but then you use just the rate here. A little simpler than. So if you just do a little algebra, let's move it from this to the next slide. Here, all you got to do is multiply by the price. So that way you can isolate the change in price, which is the number you're interested in. And these are just the different ways. You can do it this way if you have just duration, or if you have modified duration, then you can just multiply the modified duration. Don't forget that negative times the change in rate times the price. And it'll give you the change in price, which is what we're ultimately trying to find. How much is the price going to change? Now, we can talk about it as a dollar amount. Dollar value change in the price of a security to a 1% change in the return on the security. So now we can start using these duration practices to get other pieces of information that we would be interested in. So we have the dollar duration equals the modified duration. Now notice there's no negative here now. Always keep in mind, there's a common mistake that happens. Either we don't put the negative when we have to in front of it, like let's say here, or we do add the negative because we get used to it when you're not supposed to. So keep these formulas in mind. So you take the modified duration times the price will give you the dollar duration. And if you have the dollar duration and you still want the change in price, then you can just do negative of the dollar duration times the change in rate. So these are just different terms of vocabulary. Now notice, let's go back here. Here you had modified duration times change in rate times price. So what they're saying, if you just use the modified duration on the price, you can call that the dollar duration. And we're just missing the change in rate, right? So if you've given the dollar duration, then just like here, because the negative belongs, now you can just apply the negative in front of it and multiply by the change in rate. Yes, you are doing the same thing that you have here. We're just letting you know of different vocabulary terms that are used for different things. So you see dollar duration instead of modified duration and price, it means you already have this piece of the calculation. So you can just take that piece, use it this way, and you still get the same number that you're looking for, which is the change in price. Now, if you have a bond, those other ones we're assuming one payment a year. If you have a bond that starts breaking it down every 6 months, so this is a semi-annual coupon payment, the percentage change in price is calculated this way. You still get the duration that you calculated. Again, you can learn it through an Excel sheet video that we have posted. Don't forget the negative. And then just apply the change in rate divided by 1 plus the R over 2. Now, do understand this entire piece is the denominator. So if you're doing a linear equation, you have to put this all in parentheses. So it calculates this first before this is divided by it. It's a common mathematical issue where they end up this divided by 1 and then do this piece, etc. Just keep in mind, this entire piece is in the denominator, goes under. Immunization, just what it sounds like. You're trying to give yourself a vaccine against bad things that you don't want happening. It doesn't, well, yeah, typically it's considered bad things, but just things that you don't want happening. So matching the maturity of an asset with a future payout responsibility does not necessarily eliminate interest rate risk. This was something we kind of touched on earlier, the maturity gap. So matching the duration of a fixed interest rate instrument, that is loan, mortgage, etc., to the financial institution's target or investment horizon will immunize the financial institution against shocks to interest rates. This is a long way to say that, yes, you could do a matching of maturity to reduce the maturity gap, We mentioned in previous chapters that smaller institutions, financial institutions may use it because it's simpler. However, while it does lower some risk, matching duration will lower more risk because it's less about the maturity, is about the price sensitivity of that specific asset, because that's really what's going to change price sensitivity to the changes in interest rate. That's really what's going to change the value on your balance sheet. The price changes, not necessarily how the price changes as time goes by, but as price changes, as interest rate change over time, which also includes a time element in the calculation. So balance sheet immunization, duration gap is a measure of the interest rate risk exposure for a financial institution. If the durations of liabilities and assets are not matched, then there is a risk that adverse changes in interest rate will increase the present value of the liabilities more than the present value of the assets. So again, if you, let's say you match them by maturity only, that's fine. You did do some risk management. However, as the interest rate changes, the prices on those assets and liabilities may not change the same way. So all of a sudden, you may find yourself with a huge increase in liabilities, but your assets didn't increase by this at the same rate or by the same rate of change. Let's put it that way. Then your equity just dropped in percentage compared to your assets. You became a much, much riskier company. So immunizing the balance sheet of a financial institution. Duration gap. So now we're going to see how using the same duration number that you will learn how to calculate after you watch the Excel video we have also posted, you can use duration to start managing changes in your equity because of what you explained before. The idea is to keep your equity at a certain level because of your capital structure, because really that's what we're talking about here, will pretty much dictate the level of risk of the institution. As liabilities go up in the capital structure, then there's more and more risk. Your leverage is just going up. So from the balance sheet, remember, quick review, assets equals liabilities plus equity, which means equity equals assets minus liabilities. Therefore, mathematically speaking, the change in equity would equal the change in assets minus the change in liabilities. And that's what we are going to pay attention to. How does my equity change according to changes in my assets and liabilities? The idea is that if my assets and liabilities go through the same changes, then my equity will not suffer in that sense or not have a negative impact. In the same manner used to determine the change in bond prices, we can find the change in value of equity using duration. So we can just set up the formula this way. Change in equity equals, don't forget that negative. And in the brackets now, we're going to put the duration of assets minus the duration in liabilities. That K would be liabilities divided by assets. So it's the percentage, the capital structure piece of liabilities there. And then you multiply the whole thing by assets, and then you multiply the whole thing by the change in rate over 1 plus the rate. All right, and that you can tell, okay, if interest rate change, that means duration is going to be impacted on assets and liabilities. And once you know those, you can put in this formula, and now you know how much will your equity change according to changes in interest rate. Now, this is definitely a very valuable way to use duration. So these are the three effects that are key elements according to the formula. So leverage adjusted duration gap. The size of the financial institution, that's the assets. The size of the interest rate shock. So all these are taken into consideration in order to keep that change in equity in check. Here's an example, just so you can follow with the numbers, see if it makes make a little more sense to it. So let's say that the duration of the assets, when you calculate, you end up with a 5, and the duration of liabilities has a 3. Now notice it's a difference. Now you can work hard at trying to match that and close that gap as much as you can, but it's not always possible. So in this scenario, this is where we are. Okay. So let's say the rates are expected to rise from 10% to 11%. So there's an interest rate change coming or expected of 1% increase. Now, to give some numbers, let's say assets equals 100, could be $100, 100 million, about whatever, 100, you pick. Liabilities, 90, and equity is 10. So this one has the capital structure is 90% liabilities, 10% equity. So if we go back to the formula, I want to say, well, how much will my equity change when this interest rate goes up, given the duration of my liabilities versus assets? So you punch in the formula. Earlier I mentioned K, it's liabilities divided by assets. That's with a 90 over 100. So we got, don't forget the negative. We know duration of assets 5 minus the 3 times the capital structure, the liabilities part of the capital structure, which is 90 over 100. And then you multiply by the assets. Apply the change in rate as 0.01, 1% increase is positive, divided by 1 plus the current rate, which is 10%. So the idea is that in this scenario, your equity will drop. Your equity will change by a negative $2.09. So that 10 is going to go down in value by 209. And the logic behind it, yes, these are sensitive to increase in price rate. So your liabilities pretty much went up, but not at the same rate. Assets, let me not say went up. The liabilities changed, but not at the same rate. The assets changed. Therefore, your equity took the hit. The closer these two numbers are, the 5 and the 3, the less this should take a hit. And that's what we're trying to do. Regulators set target ratios for financial institution capital. And the government keeps an eye on banks and all other brokerage companies and all those financial institutions. And they want certain ratios, certain levels. They don't want these to get out of control because the risk goes up. Now, how much that changes over time, and depending on the current economic conditions or the goals of the Fed and things like that. So let's review a few of the ratios that are important. We got the capital ratio or the net worth ratio, which is your equity divided by your assets. In other words, the capital structure piece of it, the equity piece of capital structure. So if the target is to keep that ratio unchanged, we're not saying the ratio is 0. We're saying the change of the ratio is 0. So let's say you have a 10%, like in the previous example, and you want that 10% to stay there regardless of the changes on liabilities. Then what you do is you want the duration of assets to equal the duration of liabilities, or try the best you can. And that's why earlier I said, the closer these two numbers are to each other, the less of an impact you'll have here. The further apart they are, the more of an impact you'll have on the result of the change. So if these two were 5 and 5 or 3 and 3, this would have been 0 here. But if you just don't want your equity to change, the actual value of the equity, then what you do is that can be achieved through the duration of assets equaling the duration of the liabilities times the capital structure piece of liabilities. That K again is liabilities over assets. Difficulties in applying the ratio model. Duration matching can be costly. It's hard because it's not like securities and bonds out there are just fixing the duration. These things depends. There's risk levels, interest levels, the maturity are different. So matching these securities by duration is not easy, and you'll have to do a lot of calculations and analysis, maybe bringing some of the securities in, hedges, etc. It's a costly process. There's a lot of cost to it, not necessarily a transaction. So growth of purchase funds as a securitization and loan sale markets have lower cost of balance sheet restructurings. Now, things are getting better, technology and lower transaction fees, but it still is a costly process. Also, you may have a perfect duration match exactly how you want it today. Market conditions change tomorrow, and you have to rebalance and readjust. So it's a continuous process. So it's costly, but it's worth it if the risk is out of hand. Immunization is a dynamic problem. Trade-off exists between being perfect immunization and transaction cost. So yes, the closer you get to that perfect immunization, the more costly it becomes to get that extra improvement. So there's diminishing returns as you get closer to perfection. Large interest rate changes and convexity. That's a thing. So luckily in the United States, typically interest rates change at a good pace, not like huge jumps. It may happen from time to time, but typically it's slow movement. So the shocks are a little less of a thing. However, it does happen, and you have to adjust and correct to them. And then you have convexity. Now, the convexity is the degree of curvature of the price yield curve around some interest rate levels. What we're trying to say is that you have the curve, right? The price yield curve. Now, that price yield curve is not a straight line, definitely, and it has different slopes along the curve. So in some areas, it's going to have a higher impact, changes in interest rates on that curve, a certain piece of that curve, versus others. And it all depends what convexity is are you in when you're comparing certain assets and liabilities. So convexity is desirable, but understand that greater convexity causes larger errors in the duration-based estimate of price changes. So these are estimates. We will talk in another chapter all the alternatives to try to manage this issue of matching and risk. That's it for this video. See you on the next one.